Good morning and welcome to our 2021 Economic and Tax Update. Harris CPAs is excited to offer this program this morning, and we thank you guys for logging in and joining us. I know 2020 has been a difficult year, to say the least, with the pandemic and other things swirling around us, and we hope that 2021 provides, hopefully a little bit more stable time for us and the ability for us to look forward and plan ahead. And we're really excited about the speakers we have today to provide some of that background and information on how we should use it and look to move ahead in 2021. Before we get to our speakers today, I'd like to just give you a little update on Harris CPAs and where we've been for the year. We've had a tremendous growth and been lucky and fortunate enough, really because of the clients that we are able to work with, our connections in the community, and especially my fellow teammates and workers that I get to work with each and every day. With that growth, Harris CPAs, we've been able to expand our corporate office, and we've moved our new corporate office in Meridian. And we have a little video here just to show you an overview of our new office.
I'm really excited about the new office space here at Eagle View Landing. So Eagle View Landing sits in Meridian, Idaho. It's the center of the Treasure Valley here. And it's a great place that all of our clients across the entire Treasure Valley can access.
When you've got a new office space, it's almost like you're moving into a new house. I mean, you spend as much time at work as you do at your house, so you're going to spend a lot of time there. And it was clear that Harris wanted this space to be really comfortable for their employees.
We've got some very cool spaces designed for employees to just relax and take a stress break. Our job can be at times stressful, meeting deadlines, and we work long hours at times, and so being able to just pop over and play ping pong or watch a show on TV. I think if you know the people you work with better, you appreciate them better and you understand where they're coming from when you're trying to work through an issue.
Every time you hire a new employee, your culture changes, and every time you move into a new location, your culture changes. I'm excited about what this office brings to the table as far as culture is concerned. It says to our staff, you're important, and we're putting in place the things that are going to make you more comfortable in your job, more efficient. I just think it's an awesome opportunity for us.
We're growing, and by growth it means that we're providing opportunities for people. We're getting into new industries. We're acquiring more knowledge that can only benefit our clients. And so, needing more space means we have more people, which means we have more expertise to offer. Those things together are what I know is going to propel the firm into the future.
Knowing the premium that Harris places on their clients, this is the type of project that will allow their clients to come to their office, have a meeting, and then go play golf or go to a nice restaurant on site. I'm excited for Harris to be able to cultivate those relationships at a Class A project like this.
What it's going to do for our firm over the next 10 years and give us the opportunities, give our people the opportunity, everyone, our clients, our people, everyone the opportunities for the next 10 years as a firm. It's very exciting, and I'm very thankful for the partnership with ESI and BVA and everything they've done to help us create this space, create our vision of what we want for Harris in the future.
We are very excited to be one of the first tenants in Eagle View Landing project, and we're excited about the amenities and the different things that it provides both ourselves and our clients when we come and meet together, and hopefully we'll be able to start doing that here in the near future. Some finished pictures just of our office. We're still trying to put everything together, but we did move in January 4th and already enjoying the new space. This is our front entrance. We have our conference room that we'll hopefully be able to host meetings here soon. Our break room just has our core values and larger meeting area for us to get together and enjoy each other's companies. Some of our workspace here, as well as you can see off our break room, the ping pong table and some different things to kind of stress relief and enjoy our day at work, including a lounge base that we put into the space for people to hang out in, even play some old school Nintendo games or some foosball and just different activities. In addition to our new space, we've been very fortunate to be able to grow throughout the last couple of years, and especially in 2021. These are a list of the new faces that we've been able to bring on to Harris CPAs, several of these starting just a couple weeks ago. But we're very excited to have everyone on board, staff accountants, new tax managers. Our accounting services department has grown, as well as administrative support and different areas as we continue to look forward. These are spread over both our Meridian and Coeur d'Alene offices as both offices continue to grow. And in addition to this slide, since we made this slide, we've had another tax senior join us come February 1st, and we have a couple other positions that we're currently hiring for. So we've seen a ton of growth. One other thing I'd like to share, even through the pandemic, we were really excited that we were able to continue to hold our summer internship program for the universities around Idaho. And that went off, although a little bit differently with it being somewhat remote, but it went off successful. And we already have our interns for the upcoming summer hired and excited to see them come on, as well as some new fall hires in September of 21 already slated to start both in Coeur d'Alene and Boise. So Harris CPAs has been able to see a tremendous amount of growth. It's very exciting, and really the thanks goes out to not only our current employees as well as our clients and everyone on this call for supporting us as we continue to grow. In addition, I'd like to announce that we made 2 new partners come January 1st, and we're very excited about both David and Hale coming on as partner. David has been with the firm for several years now out of the Meridian office. He focuses on assurance as well as some consulting and has just been a great asset for the firm. We're very excited to see David come on as partner. Hale started his career with Harris CPAs here in Boise, out of Boise State, and then moved back to Coeur d'Alene, where he was born and raised. We got Hale to come back to Harris as we opened up an office a couple of years ago, and Hale has done a fantastic job of leading that office, as well as the merger that we had last year, merging another office in, and has been a true leader in the Coeur d'Alene market. And it's super exciting to have Hale become partner and lead that our Northern Idaho presence for the firm. Congratulations to both David and Hale. The last thing I'll say before we get to our speakers is each and every year Harris CPAs goes through a process where we look at our 5 core values and we try and identify where we can improve or where we can push the dial forward on those values. We know we're constantly trying to improve on each and every one of them. In fact, in the current year, as a member of the BDO Alliance, we were awarded first place in employee engagement and kind of development through the process that we go through to continue to work on these values. This year, in 2020, we focused on our integrity value, but more specifically accountability. And accountability not only in each other, but ourselves as well as our clients. With that, we had a ton of new initiatives that we launched and worked through, and our entire firm works through these together. But one I wanted to share was our launching of SafeSend. We were able to launch SafeSend in the delivery of our tax returns throughout 2020 and got great reviews and success in doing it. And we've added on at the end of this year both organizers and engagement letters, and we're launching that this week. And so you'll see that coming from us. But just another way for us to communicate, another way for us to increase the ease of communication between us and our clients and in delivering, and it gives us the remote possibility of both uploading and delivering all of our documents between each other, and especially in everything that's changed over 2020. This has been a great initiative for our firm, and we've are really looking forward to continuing to add to it. With that, I will get on to what we all came here for, is our economic and tax update. Our first speaker is going to be Steve Scranton. When we were thinking about how we were going to do the 2021 update with everything going around, we thought Steve would be a great speaker. He spoke for this event last year, and I know a lot has transpired. We were lucky enough that Steve agreed to come back and give us another update. I know most of us have seen Steve before. He speaks all over the Northwest, and I know I'm always very interesting and very excited to hear Steve speak. He's been the Chief Investment Officer and has been a chartered financial analyst for over 35 years now, and is really a huge contributor to the community through his speaking engagements and through the work he does with Washington Trust Bank. And so we're very excited to have Steve lead us in our first discussion today of an economic update. And so give us a couple seconds as we switch over to Steve.
Good morning, everybody. Thank you for having me back once again. It's always a pleasure to work with Harris CPA to provide you my insights. Today, I'm going to give you an economic insight of kind of talking about where we are right now, what my economic outlook is, and then things we should be thinking about. A couple of housekeeping items for you, just to let you know. I'll be taking questions through the Q&A feature that if you look at the bottom of your screen, you should see that feature. It says Q&A with two little bubbles above it. So anytime during my presentation, submit your questions and answers. I'll give a heads up to Tara and Josh that because videos are always tough to go for a full 45 minutes or an hour, I'm going to take a pause in the middle of my presentation to take some questions then, and then take the rest of the questions at the end. So that way we can keep it a little more interactive and let the audience participate sooner rather than just at the very end. What I've been telling people as we consider this pandemic that has hit and the recession that occurred because of it, and now the recovery that's going on, I've told people it's really critical that we need to understand that this is not a homogeneous recovery. I've been calling it the tale of two recoveries, and that's been showing up in various parts of the economy where you get this bifurcation going on. The first place I will highlight that to you, because I've always, for those who've heard me speak before, you know, my mantra is that U.S. economic growth always starts with jobs growth, because jobs are what creates income. Income is the fuel that consumers use to spend. And consumer spending, even during the pandemic, still makes up almost 70% of U.S. economic growth. So my view is the same. If we're considering the economic recovery, we have to start with jobs recovery. So what I've been looking at is a very clear case here of the bifurcation for jobs recovery. It truly matters where you live, because we did not have a national unified approach to the pandemic. Each state had their own procedures. There's been various and different stages of recovery of jobs because of that. And I can tell you, and there's plenty of other discussion because there's clearly a trade-off on the medical side, but Idaho, and especially the Treasure Valley, has led the pack when it comes to jobs recovery. You moved out of your phases much faster than most of the nation. You got yourself all the way to almost the end of phase 4 before the holiday season hit and pushed you back to stage 2. But the bottom line is, when I look at from the end of February, after the restrictions started in March, until we stand right now at the end of November, since we don't have state or regional data past November, Idaho itself, you can virtually call it 100% recovery. 99.6% of the jobs recovered. So just a small handful left to recover. If I look at the Treasure Valley, though, 100% jobs recovery. You have fully recovered all of the jobs that were lost. That doesn't mean, though, that you recovered the same jobs that were lost. You've actually had a difference there kind of back to this tale of two cities again, that when I look at that, what we see is that it also matters not only where you live, but it matters what you do, because what we have seen with this recovery is that there's really been a three-tiered recovery process there. If you work in jobs that make things, what we call the goods producing part of the economy, construction, manufacturing, mining and logging, that as a whole for the nation has recovered faster than the service providing side of the economy. That's had almost a 96% of jobs recovered for goods producing and only 93% for the service providing. When we look at the Treasure Valley again, and this really plays out through a lot of states, it isn't unique here, but for the Treasure Valley, very clearly, construction has led the way on the goods producing side. You have recovered 115% of the construction jobs. This is the case again where I'm saying, even though you've completely recovered 100% of your job loss, you haven't recovered the actual jobs that were lost. You've recovered more in some sectors, you haven't recovered all in other sectors. We see then also the second place is if you work in a job and what I'm going to call, from a general standpoint, a white collar job. Then you've also seen that your job situation is pretty healthy, because most of the white collar jobs, whether you're in professional and business services like accounting, law, things like that, whether you're in the financial services field, those jobs businesses were able to relocate their employees remotely, equip them with the tools they needed, and they've been able to continue to service their clients from home. And another perfect example of that, when I look at the Treasure Valley, who leads the way on the service providing side or the white collar jobs? It's your area. It's the professional and business services. You have recovered 101.4% of the jobs that were lost. Now, the area, though, that has not recovered, and it's worse on the national side compared to the Idaho side and the Treasure Valley side, back to my tale of two recoveries, is the leisure and hospitality side, the restaurant industry, the hotel industry, travel industry. Those areas of jobs for the US as a whole, 79% of those jobs have been recovered. So there's still quite a ways to go to recover from there. It's better for the Treasure Valley because you did have your restaurants open sooner. You've had your hotels open far more than the rest of the country. So what we have seen there, leisure and hospitality has recovered 90% of the jobs lost, but there still are jobs to be recovered there. So I think I really just try and emphasize to people that you may, for your personal situation, be going, what recession? Recession's over. The Treasure Valley economy is booming. Everything's great. If you try and have that same conversation with somebody who's working at a hotel or a restaurant who's lost their job and hasn't recovered it, they may not share your sentiment that way. So I think we really have to understand that it really does matter where you live as well as what you do. There's also a big, huge difference by gender, because what we have seen is not necessarily job losses, but when we look at the people who have dropped out of the labor force, means that they've stopped looking for work or stopped working, would still like to work, but right now they're not actively looking for work. There's a huge difference there. 60% of those people are women and 40% are men. I think, to me, the story that's going on there, this is the story of having, lack of daycare in many cases, having virtual learning where kids are learning, at home, not at schools. Well, one of the parents has to then stay home. And quite often it is a woman. And in many cases, they've had to quit their job, especially if you're in the industries like leisure and hospitality and stuff. Your employer is not going to say, sure, you can work from home. So that's the thing that I just try and keep emphasizing to people is be real careful of not assuming that the economic recovery mirrors what you yourself are experiencing personally, whether you're experiencing a very good experience or a very bad experience. Because like I said, I think especially in the Treasure Valley, many people could be saying, man, things are pretty much back to normal. While somebody else is saying, man, I know what it feels like from the Great Depression of not being able to cover my rent, suffering from lack of enough food, things like that. So I really do think it's important that we all keep that in mind, that this is not a homogeneous recovery. This is a recovery that has been going in fits and starts. and will probably continue to do that type of pattern. The other area that I focus so heavily on is I truly believe that, if you don't have small businesses, you don't have economic growth. And who has been hurt worst from the decisions made by governments when the pandemic hit? It has been small businesses. That's throughout the globe, but especially in the US, that we have really seen small businesses hit the hardest. So this has been a case, again, of the tale of two recoveries. If you're a big Fortune 500 company, you're probably saying things are going fine. My earnings are recovering very nicely after the big drop initially. But if you're a small business, you may be hanging on by your fingernails, hoping that you can survive until your business gets fully reopened. And you have not had near the amount of assistance that big businesses had. Big business, especially publicly traded companies, they had the ability to borrow dirt cheap, at practically 0% interest rates. So they could borrow to bridge themselves until the economy started reopening more. That's not been the case for small businesses. Small businesses, the best they've been able to get are tax breaks and then the Paycheck Protection Program. The problem, though, for a lot of small businesses, especially the leisure and hospitality section, even with the new round of the Paycheck Protection Program, 60% of it has to be dedicated to employee wages and related items for the employee. Well, if you're shut down or you're heavily restricted, you can't bring those employees back to work. And so I think that's the problem. Is we've seen for the individual themselves in the US with the action that Congress has taken, first with the CARES Act, then with the follow-up $900 billion they passed at the end of the year, and now the new legislation they're looking at. What they have essentially done is they have replaced the income for most Americans that they lost because of the pandemic, either by being unemployed or having their wages cut or just their overall earnings cut. So they've seen the unemployment benefits, the extra weekly paychecks that go with those unemployment benefits. They've had their stimulus check. They've gotten two now, the first one for $1,200, this one for $600 to start, and now another proposed $1,400. So the average consumer from an income standpoint hasn't been damaged nearly as much as a small business who may have had assistance in meeting payroll, covering their rent and things like that, but there's been nothing to replace the actual revenue that has been lost from that. And you see so much, especially for the leisure and hospitality industry, even those restaurants that are open, they are losing money, on a daily basis doing that. So I think we really have to pay attention to what is happening to small business. And what I would highlight to you is what we see. I look at, it's tough to look at the government data because it's so dated usually. It's at best a month behind. There's a project that was started called the Opportunities Insights Project, started by Harvard University, along with Yale and Brown University, and many foundations like the Bill and Melinda Gates Foundation that have funded it. They are looking at more, close to real-time data. They are looking at actually like credit card transactions, electronic payments, things like that, so they can see faster what's actually going on. And what I would reflect to you, this is the difference that we see as we look at we're into earnings seasons now for the publicly traded company, and the projections are for, the large companies, revenue losses, maybe in the 10 to 15% range from the year before. But when we look at small business, what we see is the change in revenue from the end of 2019 through the end of 2020. It really is the tale of two situations again, because what we have seen is, as an overall, the US has seen for small businesses, revenue is down 31% for the year. That is not a trivial number. But when you look at the breakdown of it, once again, if you're looking at professional and business services or those white collar type of jobs where you can work from home, their revenue is down 11%. But if you work in leisure and hospitality, excuse me, your revenue is down almost 64%. It's a staggering number. So that's the perspective that I would give, is it really is that, tale of two recoveries, that it matters what kind of job you're involved with as to how your revenue stream looks that way. When I look at Idaho, they don't break it all the way down to the regional level for the Treasure Valley, but Idaho clearly looks better because you were open faster. The change in revenue for overall small businesses in Idaho down 15%. And you even had one category that was actually up 5%. And that is, and they've lumped these two together, but it's retail and transportation services, retail, trade, transportation services. So what that tells me is, people even stuck at home, they're still buying stuff online. So retail has survived far better than a lot of people thought they would. And if you're buying that stuff online, you need someone to pick up those goods from the warehouse and then deliver them to the person. And that's why transportation services has benefited as well. The other areas, same basic story, that the worst category for Idaho, no different than the US, is, excuse me, the leisure and hospitality section, but you're only down 34%. Now I'm going to tell you once again, I always have to be careful when I say only, because from a real life perspective, absolutely 34%, far better than the 64% for the US. But try and tell an Idaho leisure and hospitality business, hey, you're good. You're only down 34%. They'd probably throw you out the door right away by trying to say that you're in good shape. So relative measures, you got to be very careful on, because this is real life people we're talking about, real life businesses, and being down 34% is not a good picture. It just shows the work that still needs to be done. Even though we've fully recovered all of the jobs in Idaho and the Treasure Valley, there is still a lot of work that needs for small business to support them, to get them back on their feet. And I simply say that's where we've got to find the balance between focusing on the virus and the medical situation and focusing on business and trying to find the right balance. I'm not saying Idaho has the perfect balance. I'm not making any judgment calls at all. I just simply say, by observing from an economic standpoint, Idaho's approach appears on the surface to be better balanced. That you've opened, the economy up until the holiday season was opening faster, businesses were recovering better, but you were paying the price on the medical side, as everybody can remember for Ada County in the fourth quarter, how you had your hospitals, at maximum capacity, at risk of having to make judgment calls of who they were going to treat or not. So there is that trade-off on, the medical impact versus the business impact. But I just continue to say, we've got to find the right balance, and we really have to look to say, how do we get the economy reopened, period, no matter what the balance turns out to be. Because what I tell people is, and I'm not trying to sound cold-hearted or anything, I'm just trying to keep people's perspective. We have so much media coverage telling us how the virus is killing individuals. That is absolutely true. Those numbers are accurate. But what is not getting covered, and I feel is that, should be covered, is the fact that even though viruses are killing individuals, restrictions are killing small businesses. How much do you see media coverage? We're not getting daily updates on how many small businesses shut down each day because of the restrictions. So that's where I'm talking about this balance, is that we have an imbalance, especially in public awareness, because the media is covering the medical side so heavily and is not covering nearly as heavily the business side of what that's doing, the economic impact of small businesses. I think what I would give you for a perspective there, and again, I don't want to sound like I'm being gallows humor or anything like that. I think that what I want to highlight to you, though, is that when I look from the Opportunity Insights Project, the change in small businesses open in 2020. They actually go through a process. They're looking for businesses that have actually closed permanently, not temporarily. And what we see for the U.S. is the number of small businesses open from the beginning of 2020 until the end is down 30%. It's a case, once again, of the case being of a tale of two recoveries, because what we see is that, once again, it matters what your business is, because professional business services, number of businesses closed or open is down 16%, while once again, leisure and hospitality down 48%. We've lost almost half of our leisure and hospitality small businesses. The other side that I would tell you, when you look for Idaho, same story. It's just a relative thing there. For Idaho, you're down 24%. Professional business services, the same as the US, down 15%. And then leisure and hospitality, similar number, except not nearly as bad, down 28%. So that gives you some perspective of what's going on from the business standpoint, of saying, here's what's going on with small businesses. This is what we need to be emphasizing with our congressmen, with other people, is how do we support small businesses? What do we have to do to keep them operating until we can get the economy reopening again? Like I said, we've built this bridge for individuals, giving them income to try and hold them over We've, allowed them to delay their mortgage payments, their rent, and even for student loans, to freeze their student loans so they don't have to make payments until we resolve the pandemic situation. But we have not given those same type of support to small businesses. But even if with that type of negative news, and yes, I know that sounds negative, but I just simply say it's reality. I always talk about out of crisis comes opportunity. Well, here's some evidence for you that there are people, entrepreneurs, who are seeing opportunity, because I look at the Census Bureau data, and this is through December 2nd, that they are showing the number of small business applications that are occurring. So again, in theory, if you're applying for a small business license, that means you plan to open a business and be able to move forward there. So I think it's a case, again, we always talk about in general, as a sweeping generalization, small businesses by nature are entrepreneurs. And they don't know the word defeat, that if they don't succeed in one business, they regroup, they look for new opportunities, and they try again, maybe with another business. So this is what I'm looking at from the small business applications. What I see there is the encouraging side, that at least for the US, small business applications are up 42% from the beginning of the year. That doesn't mean those all turn into businesses though. So they actually break it down so you can see it, and they identify what they call the high probability applications based on the information provided, historical records for that type of business. And they show you how many of those applications do they classify as high probability of actually opening their doors as a business. And that's for the US is up 32%. More importantly, I look at saying if we want a multiplier effect, not only do we want you to open a new business, we want you to have employees, so you have the multiplier effect of them being paid wages, being able to spend, and help the economy that way. So when you look at the details there, what I would tell you is those business applications that identify that they intend to have employees and pay wages for the US is up 34%. I think that's encouraging. That's the type of underneath information that doesn't get easily covered by the press, because many of you have heard me say before, bad news sells, and that's what the media covers. But there is some stuff, beneath the surface that is definitely positive. Looking at Idaho, same situation, not quite as strong, but still very encouraging. The number of small business applications from Idaho is up 23%. When you look at the high probability ones, it's up 10%. But more encouraging for me is when you look at the applications that plan to have employees and pay wages, up 20%. So I think that's what I would highlight, is that small business is very clearly where we need to focus, help them bridge through the crisis so they can survive. But it's also encouraging to see that there are people seeing that there's opportunities amidst this crisis, and they're looking for the opportunity to take advantage of that by starting a business to service whatever that area may be. They don't break out, so I can't tell you what it is, but just intuition for me, I would say somebody who may have closed a restaurant may not necessarily be saying, I'm going to open another restaurant. They may be saying, hey, there's opportunities over here, so now I'm going to open up this type of a business. But I just say by nature, small business are entrepreneurs, and I think that they do plan to always move forward and say, okay, that's behind me. I'm not going to think about that. I'm focusing on what's going forward. So let's just take a minute to go ahead and take some questions. I'll take a look here at the Q&A and go through to ask those questions, or if either Josh or Tara want to read them out to me, I'm happy to answer them anyway, because I think there may be a few if we see it, but let me just take a look on the Q&A side. I think there may be 2 questions. So the first one says the national debt has risen by $5 trillion since the beginning of 2020. What are the ramifications of that, and what effect will President Biden's additional stimulus plan have? The immediate ramifications are not much, because we are discovering, and I think maybe the Bank of Japan model, even looking longer term, the Bank of Japan and the Japanese government has issued, trillions of dollars of debt, and their debt to GDP is, just sky high. And yet they have yet to see any true problems to them from the global markets or anything like that. So I think that what I would say is that it's clearly a concern to me. I mean, anybody who thinks that we can just print money and not have to worry about it is kidding ourselves, because what you've just done is kick the can down the road to your kids, to your grandkids, or somebody like that. But in the short term, the reason why we haven't seen much change in interest rates, even though national debt has risen by $5 trillion, is because the Federal Reserve's balance sheet has risen by virtually the same amount. So what that means is that even though legally the Federal Reserve can't directly buy the US government's debt from the Treasury, they can buy US Treasuries in the secondary market. And so they're buying up that supply of debt. So the new supply that's coming in from the new debt issuance is kind of left it neutral for bond investors. It hasn't been a case that normally would say, wow, with a big increase in supply, you better find more buyers. Otherwise, prices have to go down to attract those buyers. In this case, they found a new buyer. It's the Federal Reserve. The Federal Reserve is still and has indicated they have no plans to change this anywhere in the near future. You know, testimony from Chairman Powell is that now is not the time. That's further down the road. So what we're seeing is that the Fed is buying $120 billion every month, and that's broken out 80 billion of US Treasury debt, and then 40 billion of mortgage-backed securities to support the mortgage-backed market and keep mortgage rates low. So we've had this whole pandemic. We've issued massive amounts of new debt to fund these fiscal aid programs. And we've got the stock market skyrocketing to the moon. And we've got the bond market, even that is just kind of, you know, where it's been all along. We've actually, on a net basis from the beginning of March, when the pandemic hit, interest rates are lower than they were then, even though we've issued $5 trillion of debt. I simply say that can't go on forever. What's going to change that, which I don't have the magical answer for you yet, but what we need to be watching for is when a viable alternative world currency comes along. Personally, I don't see that happening from another government, even though China would want to be that. I think where we have to keep a close eye on is the crypto world. You know, right now, cryptocurrencies are not a currency. They're actually an investment, and they're a very speculative investment that can make you very rich or very poor. But you can't have a currency that swings up to 40,000, drops down to 34,000, swings up and down. That, you know, just people wouldn't tolerate that as a currency. But I continue to say there's a message from people saying we want to have something that a government can't manipulate by printing a ton of it, you know, whenever they want to, that is dictated by something else. Similar to what we used to have with the gold standard cryptocurrency, you know, that is limited by what can be mined, that type of process. So that would impose fiscal discipline on governments. The problem is that would cause a ton of pain for governments because they'd have to radically cut back on their spending and things like that. So there is nothing out there yet, but the way technology continues to advance, I would, from an initial standpoint, say the US probably has at least a decade before they have to worry about it, but we may discover a decade in technology terms is a lot shorter. So I do think we have to just continue to monitor the maturation of the crypto world. And when we see it getting to a point where it actually becomes a viable currency, then all world governments need to worry, because then they cannot be the spendthrifts that they are now of just issuing debt anytime they want to fund their spending needs. Any concerns over Biden's appointees so far? I haven't seen any major. Of course, the one that I focus on more than others is like Treasury Secretary. You know, Treasury Secretary Yellen, I can tell you the one thing you're going to see there is a close partnership or relationship between the Federal Reserve and the Treasury, that there will not be much conflict going on there. But I can also tell you from a general standpoint, I am by nature, the way my parents raised me, I'm fiscally conservative. I believe that you shouldn't spend money you don't have. And I worry, especially with Yellen's testimony yesterday during her confirmation hearings, that she's saying that, you know, that the US should go big because with low interest rates, now's the time to issue a bunch of debt and give a huge stimulus to the economy. I just continue to say history has shown over and over again that government management of the economy is the most inefficient way you can. So providing like what we've seen so far, you know, over almost $4 trillion in financial aid to the consumer, that is temporary income. That is not an investment in the US that gives us long-term returns on that investment. That is money that gets spent and then it's gone. And so I don't believe that's the right solution for the long term. I have no issues in the short term, given that the government in their decisions to lock down economies really caused the problem. They should provide the bridge. but it should only be a bridge, and then it should end, and they should then be investing or supporting through regulations and other things so that free market enterprise and businesses can then get the economy back on its feet and moving forward with growth that way. So at this point, not a lot of concern with the appointees. Do I think it's advantageous to lift restrictions for economic recovery? I'm not going to say advantageous, but I think that there has to be the balance. And what I have tried to argue, but a lone voice out of Spokane, Washington means nothing to the politicians. I had really tried to advocate saying, especially for the second round of restrictions, when the holiday season hit and we had all of the virus surge, I said that we have enough data, we have the contact tracing, even though it's not perfect, that what I would have suggested is rather than doing what the state of Washington and many other states did, this blanket lockdown again, especially on the leisure and hospitality industry, I would have said, okay, we'll allow you to stay open as long as you're following the medical protocols of requiring people to wear masks, social distancing 6 feet apart, not having large, dense gatherings. And then if you have an outbreak, then we're going to shut you down until you get that resolved, but everybody else can stay open. To say for all of these businesses who are doing everything they were told to do, and they followed the rules, and yet they still got shut down, I struggle with that as an economist. I don't think that's an efficient way, just like I struggle with the stimulus that we had in the first round, and we're seeing it again in the second round. Many people who were making less than $75,000, but were still working full time, got a stimulus check. That was fabulous for them, kind of free money. Many businesses throughout the U.S., in the Treasure Valley, throughout the Northwest, throughout the Rocky Mountain states, they were getting by and they had their employees still employed and probably would have been able to continue to get by. But when you're given the opportunity to get free money by taking out a PPP loan, following the rules, meeting the guidelines, and then having it forgiven, we had a lot of businesses that also maybe should not have had that money. And we had other businesses, especially the very small businesses, that just couldn't get through the paperwork and get that assistance. So a blanket of statement is saying we should lift all restrictions, no, but a targeted, more refined approach, I absolutely think there's an economic advantage to that. Let's see, what percentage of those small businesses being applied for are sustainable? That is not disclosed because you won't know that over time. I forget, and I apologize, I could probably go back and look what the failure rate is for startup businesses. I think it's a pretty healthy rate, but even still, even if you just get a handful of them that are successful and employing people, that's a help to the economy. But I apologize, I don't know. The census doesn't break out if they think that they are sustainable, but a track record, I could probably go back through the Census Bureau data to see what is a survival rate of a typical small business. I'm assuming Biden is able to pass his minimum wage hike. How do you see that affecting small business and the economy as a whole? I have always said, as an economist, from an economic perspective, a forced decision on businesses is not an efficient decision. So I've said, if a business is successful and you see that you're having trouble, the biggest example I can give you for that is the construction industry. Consistently from the National Federation of Independent Businesses, their number one struggle for small business is finding qualified help. Well, if you're a business like construction that you're trying to attract help, you're going to be paying more than minimum wage. The market demands it, saying if I'm going to attract somebody to come work for me, I've got to give them more benefits or more wages to try and get them to come work for me. To tell people, especially businesses like the leisure and hospitality industry and other lower paying industries, that no, here's your new wage and it's going to be $15 over what graduated time frame, then you've imposed a cost on them. It's like a tax. You put a new tax on them, and that either breaks them and says, I can't operate them. And then rather than paying your employees higher wages, you unemploy them because you shut your business down. So I always struggle with a mandated decision on a business rather than letting the market forces determine where that should be, because I do think the market is still efficient on the wage side. You can maybe argue for inefficiencies other places, but not on the wage side. Let's see. One last, and then I'll go on and I'll take the next round of questions at the end. For businesses that had a PPP loan forgiven, have they established whether the loan amount will be taxed? I am going to tell you that you have the experts that can answer that question for you with Harris CPA. I am not the tax guy, And I learned long ago, don't venture into an area that you don't have expertise on. So I will bounce that question, and maybe with the next presenter, if they have it on their agenda, they can answer it. Otherwise, talk to the person you work with at Harris CPA. They are going to be able to help you with the whole tax maze that we're dealing with some of the proposals there. So let me move on there. Thank you for all those questions. I always appreciate, and I think it's great to stop in the middle to get those questions from you. What I want to talk about now is my economic outlook, and then things I think we need to be considering there. So from an economic outlook, the main thing I'm going to tell you is this, I'm not trying to be flippant or anything, but when people say, so what's your economic outlook? My first question usually is, tell me your scenario for the vaccine and how that's going to go. Because what I continue to say is, because this recession was caused by a medical issue that triggered decisions by governments to restrict businesses, as the battle with the virus goes, so goes the economy. So if we do have very efficient distribution of the vaccines, and more importantly, because this is where I worry the most, I'm already seeing the evidence that we've politicized vaccines, just like we politicized the virus itself, that people refusing to get the vaccine because they think it's a government plot or something like that. I'm not even going to venture down that road. I just simply say the lower the vaccine acceptance rate or the amount of people getting vaccinated, the longer the restrictions are going to be in place, the slower the recovery will be. If people say, I'm getting a vaccine and we have a high acceptance rate, we can lift the restrictions very quickly, then the economy is going to rebound very quickly. Because the reality is, stop and think, we've got $900 billion flowing into the economy from the fiscal aid package passed at the end of the year. We're talking another 1.2 trillion. I think it'll be a smaller number, but let's just say another 1 trillion or something like that. That you put $2 trillion into the economy, it will have a positive impact. The question is, how long will that impact last? But I do still say, as the battle with the virus goes, so goes the economy. That's my biggest perspective that I would give you there. I also want to give you the perspective that we had this massive drop in the first half of the year, the drop in the first quarter, and then the massive drop in the second quarter. We had the nice big rebound in the third quarter. That rebound took us back to the point where we're now 3.5% below the level that we are at the end of the last year. And the perspective that I want to give you, that's good to see, but the perspective is, during the financial crisis, the worst of times of the financial crisis, we all remember living through that, we were 4% below where we were at the end of December 2007. So in essence, even though we've had this big rebound, we are still have a road to go down before we fully recover there. And that comes back to, again, how quickly we can get restrictions lifted. But that's what I've told people is, I really have the perspective that we've had two events happen. We had a depression that happened in the second quarter of 2020, when we had the massive drop in GDP, the massive job losses. We had massive action from the Federal Reserve, from fiscal monetary policy. We had massive action from Congress. We pulled out of that very quickly, but we are now back into what I would call a quote unquote traditional recession, and we still need to work our way through that. When we still have almost 20 million people receiving unemployment benefits, that tells you we are not near ending the recession yet. Even if they officially declare it over, in a real life perspective, we still have work to do. So I just want to give you that perspective to start. But the answer that I'm going to tell you is, consumer spending is what it's all about. So what's happening with the consumer? And what I will tell you is, because of the new round of lockdowns in the fourth quarter due to the virus spread during the holiday season, I think we're going to see a weak first quarter. And then depending on what happens with vaccines and stimulus, we could have a very, very healthy rebound in the second half of the year. But right now, let me give you a footing to start with. This is as of January 3rd, going back to that Opportunity Insights project. What I would tell you is, consumer spending, even though they've had their wages replaced for them or their income replaced, they're not dumb. They know that, hey, that's temporary. And I still have rent to pay sooner or later. I still have my student loan debt to pay, that type of thing. So what we see is, overall for the US, consumer spending down 2.8% through December 31st. Once again, tale of two recoveries though, because if you're in the retail business or you're in groceries, life's been good, because on the retail side, they are actually up almost 17%, and the grocery side is up almost 15%. Flip side though, as we've talked about, Transportation, nobody wants to fly on a plane, nobody wants to get on a bus. Transportation spending down almost 44%, and entertainment and recreation almost down 55% from where they were spending at the end of 2019. If we look at Idaho again, relative, once again, same basic story. The good news though for Idaho, overall spending in Idaho up almost 7.5% because of the fact that you reopened at a faster pace than most of the US. Retail is still the story and grocery still the story. Both retail and groceries up over 20%. Transportation and entertainment recreation, same story on the other side. Transportation down almost 29% and entertainment recreation down almost 45%. So that's where we're starting from because we weakened in December because of the new rounds of lockdown, even for Idaho moving back to stage 2 from stage 4. So I think that we're going to have a weak first quarter because it's going to take a while for Congress to decide what they're doing with the legislation. We will get the benefit of the $900 billion coming in. We've already seen evidence of the especially lower income people spending the money they're getting because they need it. So I'm not saying that we're going to see spending collapse. I just think it's going to be very muted, but then we have the chance to move from there. I do not think that anybody, well, I've seen plenty of people arguing it, but I just can't understand the logic. I don't think we can call a V-shaped recovery because we've had these setbacks, this type of thing. So what I'm telling you is what I think that we could see is very similar to what we saw after the financial crisis, a V-shaped recovery. We have the big drop. Now, once we get the vaccines implemented and get the economy reopened, we get a big bounce. I've seen some forecasts as high as 11% potential for 2021 if everything goes right. And then we level off because most of that stimulus is a temporary stimulus to replace income lost, things like that. And I think that because of the amount of debt that we've issued and the fact that we still have so many jobs lost and people out of work, that I think that we could see economic growth positively growing, but stuck in the 1.5% to 2.5% type of range. After the financial crisis, we got the bounce, and for 10 years, we bounced between 2 to 3%. And that's really kind of where we were stuck at. So I think it could be a very similar scenario, just depending on what we discover once we fully reopen the economy, how many small businesses that we thought or were hoping were temporarily closed actually end up being permanently closed. So I think that's what we just really have to pay attention to. And I'm not going to give you any official forecast because I think anybody that's doing that is just an educated guess at best. All of the econometric models that economists use, they rely on historical data to say that that's correlated to different behavior going on. So this is what you should see. Well, this is a one-of-a-kind recession. All of those models have essentially been blown out the door because, as we've seen throughout 2020, forecasts missed on these monthly economic numbers, regularly missed by big amounts because I think the models just couldn't handle how this recession responded versus traditional recessions. I think that you should expect we're going to see low interest rates for longer. It's just a fact of life that we are going to continue to see the Federal Reserve holding down interest rates because they think that's what we need for the economy. I continue to say there is two tails there as well. Low interest rates are great for borrowers. So if you're looking to buy a house, probably good news because you're going to continue to see low interest rates. Although I will warn the younger generation that rates will vary. I think especially long-term rates will still bounce around. We could see 30-year mortgage rates bounce between 2.5% to 4%. But I'm going to continue to try and emphasize to you, even though from your own personal experience of your lifetime, 4% seems like, oh my God, that's such a high rate. It's not a high rate. It's barely a rate worth mentioning. That's still a very attractive rate for buying a house. So the Fed is going to remain committed through their purchases of mortgage-backed securities. And if necessary, as the Treasury is issuing more debt and more of the longer-term debt, they will shift their buying process. Right now, they're buying predominantly short-term maturities for Treasuries. They could very easily, without having any increase in the amount of purchase, they could shift and stop buying the short maturities because there's plenty of people who are still parking their money in cash in the short end and start buying more 10, 20, and 30-year maturities. Treasury Secretary nominee Yellen proposed even potentially a 50-year security. I would even go so far to argue if this is really the path that the U.S. wants to have, is having the Federal Reserve buy up so much of the debt, they should issue a 100-year Treasury security. And because of Yellen's close relationship with the Federal Reserve, since she used to be the chairman of the Fed, she basically sends the message to the Federal Reserve, we're going to issue it, you're going to buy it. And then we won't affect interest rates overall. I don't think that's going to happen, but I think that is something that is a possibility if things really got distorted for the US on their debt situation. I think short-term rates, though, if you're a saver, life is going to continue to be miserable. There's going to be very little change in your savings account rates, CD rates, money market account rates. The Fed is committed. They don't plan to raise those rates till the end of 2023 at the earliest. I think it could be even longer than that. So we need to live with this low interest rate environment. It's not a great scenario for financial institutions where you're a bank, thrift, or a credit union. Low interest rates means your interest margin is being pressured lower as old loans mature and new loans are put on. So it's going to be a case again, the well-run, efficient firms will do fine, and we'll probably see some mergers going on for smaller firms that even if they're well-run, they just say, I can't make money doing this, so I'm going to sell out to a bigger bank so I don't have to deal with this type of situation. The other thing that I would tell you that we should be planning for is we should plan for, or what we should be thinking about now. I think this is the things I would tell you we should be thinking about. I don't have answers for you. This is more is to challenge your thought process and decide what you want to do. But the first thing is trade policy. Even though for Idaho, it's not a big number like the state of Washington. Washington exports account for almost 20% of their GDP. Idaho is closer to 7%. But 7% is still 7%, especially the agriculture industry. Trade is an important thing. I'm not a trade expert, but I'd give you the quick thoughts. Everything that I've seen so far from President-elect Biden is that he is not going to change anything with the tariffs with China because he wants to create a multinational coalition with Europe and other countries who are also being affected by China's trade policies and attack China trade as a unified voice. That's going to take time. If anything, I think there's some risk on the ag side that each of the ag businesses will know whether they're affected or not. But President Trump exempted certain industries or businesses, and those exemptions are expiring, and he did not renew those before he left office. At least I did not find anything in reading through all the Federal Register and stuff like that. So there may actually be some new tariff to some businesses, including the ag side, because of the expiration of those exemptions. But overall, I think that Biden is not going to use tariffs as much as President Trump did. He has a different philosophy. I think you have to consider what his approach is going to be. President Trump felt it was better to deal one-on-one with each nation and make your own trade deal with that nation. President-elect Biden believes multilateral is a better way to do it because then you can have that unified voice for those countries that are having unfair trade practices. So we'll have to watch and see how that develops. But for now, don't expect any immediate relief on the tariff side. Fiscal policy, I've talked to you about. I think that's going to play a far bigger role. The biggest difference we have now compared to the financial crisis recovery, fiscal policy did nothing for 10 years during the after the financial crisis. Too much bickering between Congress and the Senate and the House. No major real policies until near the end when we had the Tax Cut and Jobs Act. This time around, fiscal policy is playing a huge role. It's already intervened, with the crisis, and it looks like, there's a desire to continue to intervene. So I think we have to pay attention to what that means. I don't think from our discussions with our independent research firm that 1.9 trillion proposal is going to fly. It's going to be a smaller number because the Republicans feel there's too many things in there that are not related to disaster aid of helping people in need, like the minimum wage has nothing to do with providing actual disaster aid to people who are out of work, things like that. The number that we've heard being thrown around is more like 700 to 800 billion is the level that there's closer agreement between the Republicans and the Democrats. The rest of it going to be very difficult to get through. They'll have to attack that with the next round, which President-elect Biden has already said he wants to tackle a bigger spending policy towards the second half of the year, focus on infrastructure, what I'd call true fiscal stimulus, investing in infrastructure, climate change, things like that, that would actually be an investment into the economy and generate returns from that. That remains to be seen because my bottom line that I tell people is I've heard so much angst from a lot of people. saying, look, first, even with the tax hikes, it's for, the target is people making more than 400,000 a year. That doesn't impact most of us. And the other is that we have a 50-50 Senate. So you have to have 60% votes of the Senate to approve a bill outright. Otherwise, your only option is to go through what they call the reconciliation process, where you only need a majority, but you can only do that once a year. So the Democrats will have to figure out what's the most important things you'd want to get through, and it has to be related to budget type of things, not other things that aren't directly related to that. So I still think we may discover a lot of worry didn't play out as much as they thought, because the Republicans still have the tool available to them at this time, which is the filibuster, to prevent certain legislation from passing there. Really is going to be the question is, will we see compromise between the Republicans and the Democrats? The other thing we know for sure, I'm not going to cover in any detail because this is the expertise of Harris CPAs, but there is clearly discussion of higher taxes for corporate America, higher taxes for our high net worth individuals, reductions of deductions for some people, raising the tax on capital gains and dividend income. And most importantly, I think for small businesses, once again, they could have the outsized income depending on when are the taxes effective if they succeed in raising taxes. There's been talk that income tax related could be retroactive. Capital gains and dividends, forwarded from the point of when the legislation was passed. And so far, the discussion for higher corporate taxes is for 2022 because they want to let the corporations recover from the effects of the recession. But like I said, I'm going to leave it there. You can talk to your tax experts because that's what they're here for. And they will do a great job of walking you through that maze of what's going on from the tax standpoint. The last thing I would tell you that you need to focus on is workforce migration. That is real. It's going to continue to happen now that corporate America has decided that people can work remotely. The reality is the Treasure Valley has had amazing growth over the last 5 years or so because of many of your policies that made you an attractive state as a whole, an attractive area to come to. So I think that, the opportunities that you see if workforce migration continues, you see population growth, so you expand your tax base, absorb the burden of that growth with more people to pay those taxes. I think that you would overall see higher wage growth because a lot of those people who are coming and saying, I want to live in the Treasure Valley, who came from Seattle or from the Silicon Valley, they may not make those Silicon Valley wages anymore, but they will still be making higher wages than the average hourly earnings for the Treasure Valley as a whole. So that's a good thing as well. It also can create diversity of business types that you won't be concentrated in one type of industry or anything like that. Even though you may not have the physical location of that business there, if you have the employees of those different types of businesses, you have better diversity for when the next recession happens to absorb that because you're not hoping that the area that you have the biggest exposure to takes a big hit there. You'll have it spread out much better. And the bottom line is better economic growth as a result. And who wants to complain about better economic growth? But as you have well learned, I've told people in other areas, especially in our markets in Washington and Oregon, to say, take a look at Boise, and there's your model of what you need to be prepared for. Because now you're suffering the stresses on your infrastructure. I hear the complaints about traffic jams. Geez, you don't want to head towards Nampa after 3 o'clock in the afternoon or coming into work, the other way, that type of thing. That's the problem with when you have growth, is that unless you are responding proactively to build out infrastructure, whether it's highways, whether it's water and energy, whether it's schools, you're going to start to have problems developing as a result. I think one of the biggest things, which is less of an issue for Boise downtown, but is an issue for places like Nampa or Caldwell or other, less dense areas. And that is the old adage for buying a house was always location, location, location. Now it's internet speed, internet speed, internet speed. And all I can say is that if we really are going to start to see population moving more towards the rural type of areas for the cheaper affordability and the quality of life, then we better hope that Elon Musk's Skylink satellite internet with high-speed internet proves to be real and successful, since he claims that they're going to have that online by 2021, because that would be really key. I also think, though, you've got to pay attention, especially for the Treasure Valley, but it's throughout different areas. Ag is an important part of your economy overall. And what you start to face is the challenges for both the demands on energy and the demands on water. And the last thing or the worst thing you're going to do is ration water that the ag industry may need or jack the energy prices sky high, that you start putting even more farms out of business. You've already got the demographic dynamics going on right now that with the baby boomers starting to retire from the ag industry, their kids don't necessarily want to be in that business. And we're seeing more and more ag farmland going out of production just from that demographic feature. The last thing you want to see is having energy and water costs and multiply that effect there. And the last thing I would say is any city faces this. You know, the Treasure Valley and Idaho as a whole, traditionally, very conservatively focused with their beliefs, with their spending policies and everything else. The people moving in from the Silicon Valley or from Seattle or other places may not share that belief system or that philosophy. And the real key will be how well can you integrate that so you don't suddenly have a split happening in your city or your region as the two opposing forces fight with each other because they have different agendas they're trying to accomplish there. So I think those are some major things that I would advocate you need to be thinking about. What I would do once again is look for the last round of questions and then wrap it up so that we can turn it over to the next speaker. Let me just take a look here. I don't see, looking at my question and answers and looking at the chat box even, it looks like there's no new questions. So the thing that I will leave you in closing then, and then turn it over to your next speaker is, one, I always emphasize, and I say it over and over again, out of crisis comes opportunity. And so it's very easy to focus on the negatives because that's what the media focuses on. And one of the things I've said over and over during 2020, it was a message that our chairman gave all employees when it first started. He used the term, we should all go on an information diet. What he means by that, and what I would strongly advocate is, especially if you're working from home, when you are at work in an office, I suspect you didn't have access to a TV and watching 24/7 news the whole time. You just focused on your work. I would strongly encourage you to turn off your TV while you're at home, focus on the important things, which is your job, it's your family, those types of things. And I think you'd be amazed at how much better you feel than having that 24/7 news blaring at you. I would also say that it really comes down to the longer that the restrictions are in place, the longer it's going to take to recover. So I know the nation is heavily divided right now. We've politicized so many issues. I'm not going to try and convince anybody one way or the other because I know that beliefs are beliefs and everybody's entitled to them. I simply say from an economic standpoint that if we know what the criteria is to reopen and we choose that we're not going to follow those criteria, which are the medical protocols, you're going to face a longer time period before the economy reopens. And I'm going to also caution to say, even though Boise and the Treasure Valley is doing very well on an overall basis, you are not an island, you are not self-sufficient. So what happens to the rest of the US will ultimately affect you. And so if we're still having this division and it's taking a low acceptance rate on vaccines, it's taking longer to lift these restrictions, ultimately that's going to impact Idaho and the Treasure Valley. But for right now, I give you the simple analogy that I've used in the past. Don't look out the rearview mirror of the car to see all the damage that has happened because we can't change the damage. It's done and over with. Stay focused by keeping your head up, looking out to the future and looking for those opportunities so that you can take advantage of those opportunities and be the successful firm that exists going forward there. So I hope that today's information has been information that you can use for your business, for yourself. But for now, I'm going to wrap up my end and I will turn it back over for the next speaker. Thank you, everybody.
Thank you, Steve. And again, thank you to Washington Trust Bank and Steve for providing that economic update. It's always great to listen to Steve and get a perspective on what's going on, both nationally and in the world, but also locally here. And he does a great job at that. So thank you again, Steve, for that. Our next speaker here is Robert Shappee, a partner here at Harris CPAs with me. I'm excited to have him come up and give us a tax update. Robert has, for several years, led our tax department here at Harris and stays on top of all the emerging tax issues that we all need to be aware of, that we come to all of our clients with. And so it's my privilege to be able to introduce Robert Shappee to go over the tax update.
Good morning, everyone. As Josh said, I'm Robert Shappee. I'm a partner with the firm and have been watching taxes throughout this year, trying to keep an eye on everything that's going to affect your business or your personal tax situation. And so I just want to kind of go through some stuff. I'll take some questions about midway through to make sure that everything is making sense. And I just say that it's very difficult to do this presentation in this environment. I'm so used to seeing all of your faces in the audience and being able to interact with you. I miss that very much, and so I'm looking forward to next year being able to come back together and put this presentation on in person. So with that, let's get started. 2020 year in review. Basically, I just want to go through some of the things that happened during 2020. So 2020 was dominated primarily by the pandemic. Legislation was driven in large part to respond to the crisis and to provide economic stimulus for the economy and to make sure that things were still progressing. So there were several bills that were brought forward during the year. In response, Congress passed 3 significant tax changes, and then at the very end there was another bill that was signed into law just at the very end of the year. So we'll go through each one of those bills, and some of the tax rules that were in the first bill changed throughout the year, so we'll get through to those and I'll show you what those changes are. So as I said before, Congress passed major stimulus bills. There were still many questions that happened during the year related to the Tax Cuts and Jobs Act. So additionally, we were still looking for guidance. So that as you recall, that act was put into place at the end of 2017. The IRS is still issuing guidance on some of those rules, and some of the coronavirus aid stimulus packages changed some of the rules. So we got some very favorable rulings from that going forward. The first bill that was passed in 2020 was the Families First Coronavirus Response Act. So this was the first major piece of legislation. It was signed into law on March 18th in response to the pandemic. And there were just a few things that bill put in place. Let me just advance my slides here. Oh, we're catching up. I'm a little too quick on the clicker. So the second bill that was passed was the CARES Act. The CARES Act is titled the Coronavirus Aid, Relief, and Economic Security Act. CARES Act was signed into law just 10 days later, March 27th, to provide additional relief, and the CARES Act provided more substantial relief than the Families First Act. So the first thing that was included in the CARES Act, as you'll all recall, was the 2020 recovery refund checks. So these were checks that were sent directly to individuals who had filed. There was eligibility criteria based on your 2019 taxes. And the payments were $1,200 for each individual, or $2,400 for a couple, along with $500 for each child. The bill additionally provided for an above-the-line contribution for charitable contributions, $300. So if you were not itemizing your deductions, you were able to get a $300 above-the-line deduction. The second part of the Charitable Contribution Act is that the bill temporarily suspended the AGI limitation on cash contributions. So instead of permitting individual taxpayers to take a contribution deduction to the extent such contributions do not exceed the excess of their base, essentially in prior years the limit was 60%. And so what this provision applied to was if you were able to contribute more than that in cash, it would allow that contribution to be deducted on your 2020 taxes. There was also an employee retention credit that was made available through the CARES Act. So the employee retention credit, we're going to talk a little bit more about that because it's been modified in the most recent legislation. But through the CARES Act, the employee retention credit was 50% of the wages, limited to $10,000, so you could get a $5,000 credit for businesses that had been shut down by a government order or had had a 50% drop in revenue quarter over quarter. And like I said, that has been changed since then, so we'll go through that when we get to the CAA at the very end. The CARES Act additionally gave retirees more flexibility with early withdrawals from retirement funds. So it allowed individuals to make withdrawals of vested funds from their 401k up to $100,000 without being subject to the 10% early penalty. And additionally, they were allowed to spread the tax liability on the withdrawal over a 3-year period. So that's going to give individuals that may need to take money out of their 401k some flexibility. They also increased the amount that you could loan from your 401k from $50,000 to $100,000. So that is just some additional flexibility in the way that you can access some cash from there. For those that are already retired, it suspended required minimum distributions for 2020. So for those of you that are over 72 or 70 and a half in some situations, it depends on whether you were already in RMD at the beginning of the year, are able to not have to take your required minimum distribution for 2020. Student loan debt assistance. So included in the CARES Act was a provision that allowed employers to assist their employees with college loan debt through tax-free payments up to $54.50. So if you're an employer, you can simply pay some of your employees' student loan debt, and it's not taxable income to the employee up to those limits. They also restored the flexibility in healthcare FSAs to allow for over-the-counter medical supplies to be eligible for reimbursement through that. They had changed that rule a couple of years ago, and so this just gave some more flexibility in that arena. The CARES Act also deferred the net business loss limitation that was put in place by the Tax Cuts and Jobs Act. So as you'll recall, the Tax Cuts and Jobs Act imposed a limitation on the amount of business loss that could be used to offset other income on an individual taxpayer's tax return to $500,000. So the limitation was effective for years beginning after 2017. So you're talking 2018, 19, and 20. And it defers that limitation for 3 years, so through 2020. So any losses that your business sustained in 18, 19, or 20, you'll be able to write those off in full if they exceed $500,000. The CARES Act also changed the provisions of the Tax Cuts and Jobs Act that applied to net operating losses. So originally, the Tax Cuts and Jobs Act applied a 80% limitation on net operating losses that could be deducted on a taxpayer's tax return, and it only allowed you to carry losses forward, not backward. So the CARES Act delayed that limitation until years after 2020. So in 2018, 2019, and 2020, you'll be able to write off your NOLs in full. And if you generate a net operating loss in any of those years, it reinstated the 5-year carryback, which is very useful in planning, and I'll talk a little bit more about that when I get to the end of my slides. The CARES Act also gave us some flexibility with regard to AMT credit refunds. So many of you have been carrying alternative minimum tax credit refunds forward, and those have been dripping out on your tax return throughout the year. And so the Tax Cuts and Jobs Act is what really limited that. The CARES Act allows those credits to be refunded on an accelerated schedule in 2020. So if you do have AMT credit carry forwards that are flowing into this year, you should see them free up substantially this year over prior years. One of the biggest improvements that we saw from the CARES Act was they made a technical correction to the Tax Cuts and Jobs Act. So when the Tax Cuts and Jobs Act was written, Congress did it in a very hurried fashion, and they made several mistakes. One of the most glaring mistakes that they made was they defined qualified improvement property as 39-year property. The reason this was important is because 39-year property cannot be accelerated as far as being deducted under Code Section 179 or 168, which is bonus depreciation. So many of you that have qualified improvement property, which is your typical leasehold improvements or real property improvements, you'd be depreciating them over 39 years instead of 15. 15-year assets, however, are eligible for Code Section 179 deduction and are eligible for bonus depreciation. So by correcting this mistake and making it effective back to the original effective date of the Tax Cuts Act, it's allowed us to go back and review any qualified improvement property that was placed in service in 2018, 2019, or 2020, and effectively we're able to, in many instances, deduct the entire cost of that improvement if it qualifies. So the last bill that was passed, the last significant bill that was passed during this year was the Consolidated Appropriations Act. This was just recently signed by the President on December 27th. It was $900 billion in aid. They fought about this bill for over 6 months, and they tried to come up with something that was very tax-oriented. And so the Consolidated Appropriations Act has over 150 different provisions that affect the tax code. I'm not going to go through each and every one of them. I don't want to lose all of you already. But we're going to go through just the ones that I think are extremely advantageous. So the first is the recovery rebate. So they're going to send us some more money. The bill provides for an additional $600 refundable tax credit. The $600 is per eligible family member, $1,200 for a married couple, and then $600 for each qualifying child. So the credit phases out at income $75,000 or higher for individuals and $112,500 for head of household, or $150 for a married couple. Treasury is authorized to send advance payments in this situation, so if they can establish that you meet the criteria, you should be receiving a check. I know I've heard of a few people receiving them already. Unfortunately, this IRS has already come out because they are the major entity that sends those checks out through Treasury and coordinates that. So this is going to delay tax season for us. It is slowing down the process of getting the system ready to start receiving tax returns. And so I'll talk a little bit more about that as we get later on in the slide deck. The CAA also gives us a second bite at the PPP loan. So the bill established the criteria for certain qualified borrowers to receive a second PPP loan. The terms are identical to the first round of PPP. However, it is limited to businesses that use the original PPP for qualified uses and has no more than 300 employees. So there's a little bit of criteria that's changed, and they have to demonstrate a 25% decline in revenue in comparable quarters. And they also addressed the deductibility of PPP funded expenses. So in the original bill, there was a lot of upheaval because they came out and said that the funds that were forgiven would not be taxable to the businesses that took them out. However, very shortly after that, the IRS said, excuse me, that means that the expenses are also not deductible, which caused a lot of uproar. I know many of the organizations that I'm a part of reached out to Congress and lobbied them. Treasury Secretary was on board. This was not the intent. It essentially made the PPP funds taxable. And so the CAA clarifies that gross income does not include any amount that would otherwise arise from the forgiveness of the PPP loan. The provision also clarifies that deductions are allowed for otherwise deductible expenses paid with proceeds. And so essentially it has become tax-free now. All of the expenses will be deductible. None of the income will be picked up. It additionally adds basis. So that's my next slide talks about that. This is a very important concept. So not only are the expenses deductible, the income that is not picked up is treated as tax-exempt income, and so it will increase your basis for purposes of distributions and tax basis and calculating if you have gain on sale of your stock. So this was a very favorable position. The bill also went on to provide the same treatment for other programs such as the EIDL, the Economic Injury Disaster Loan Grants, and any of the other loan payment assistance that was provided by the CARES Act. It essentially says, hey, all of this stuff is not taxable and all of the expenses are expended. So the bill extended the refundable payroll tax credits for paid sick and family leave that was installed in the Families First Coronavirus Relief Act through the end of March 2021. So that's if you have to pay FMLA for individuals who have coronavirus or suspected of having it, you'll be able to continue to get those payroll tax credits on your payroll forms through March of this year. The CAA also allowed for farmers who elected a 2-year net operating loss carryback prior to the CARES Act to retain that 2-year carryback. Essentially what had happened is in the CARES Act, they had opened up the NOL carryback to 5 years. And what this clarification does is says, hey, if you want to leave it at 2 years, it's okay to leave that. You don't have to go in and change it to 5 years and file amended returns. It also allows you to revoke that and go back and carry it back 5. So it's very advantageous there. If there's anything that you take from this presentation, this is probably the most beneficial thing that was passed in the CAA. It's the employee retention credit. So the CARES Act originally put in place an employee retention credit. It was very restrictive. This bill expands on it, opens it up to 2021, and allows an increased amount to be credited on your payroll tax forms. So the retention credit is now 70% of eligible compensation up to $10,000 through the second quarter of 2021. It added flexibility by allowing the employers to use funds in excess of PPP funds. So in the original employee retention credit, if you received a PPP loan, you were ineligible for that program. But now, essentially what it's saying is for any wages that you pay in excess of PPP eligible wages, you'll be able to claim this credit if you've had a drop in revenue in a quarter-over-quarter comparison. And the original employee retention credit was a 50% drop. They've loosened that up to now 20%. So if you have quarter-over-quarter decreases in revenue of 20%, you'll be able to apply for a credit up to 70% of eligible wages for a maximum of $10,000. So you can get $7,000 per employee for each quarter that happens. So this could be very advantageous and provide lots of cash flow to your business. And it's retroactive back to the date of the CARES Act. So if you can go back and establish, if you had done the criteria originally and did not meet the 50% drop, but now you meet the 20%, you can go back and claim those wages in 2020 and claim the credit. So really want to pay attention to that. If you have questions about it, we have people in our office that are very up to date on all the rules and can help you with that process and go through and look at it. So the CAA is going to allow us to take 100% business deduction for meals rather than 50%, as long as the expense is from a food or is for food or beverage and is from provided by a restaurant. So that's in effect for 2021 and 2022. So if you go out to eat a lot, you go to a restaurant, the limitation on meals is suspended for those 2 years. They're trying to incentivize us to get restaurants back up and running. So it's a very positive thing that you'll be able to take. The CAA also extended the above-the-line contribution for charitable contributions that was put in place by the CARES Act and doubled it. So if you are not itemizing your deductions, you can take a $600 above-the-line deduction for charitable contributions made in cash. and it extends that through 2021. They also changed education expenses. So they repealed the deduction for qualified tuition and related expenses on the front page of your tax return, and then went around in the back page and increased the phase out for the lifetime learning credit. So essentially they're moving away from a tuition and related expense deduction to a credit, and expanding the ability for individuals to get that credit, which is a very positive thing, because in many instances the deduction was not available due to AGI limitations. The minimum age for withdrawals of retirement funds. So the bill modifies Section 401A to allow certain distributions for pension fund participants who are over 59 and a half and still working. So if you're still working and you need to take a withdrawal from your retirement fund, you're able to do that. And they did a carve out for individuals that are in the building and construction trades, that they are able to do that at age 55. So they loosened those restrictions. They allowed individuals that had funds in their FSAs to roll them over from 2020 to 2021. So if you were contributing to a healthcare or a dependent care FSA in 2020 and you didn't use up all of the funds, you are able to roll that money forward to 2021. And it also allowed some flexibility. So typically those plans, you have to make your elections at the beginning of the year, and you're not able to change them throughout the whole year. So they put a one-time mid-year change available in there. So that's going to give people a little bit more flexibility when it comes to making decisions about how much health care they want to save up for. There were, so as many of you that have worked with me in the past on the tax extender legislation, we're always waiting for at the end of the year. It usually comes in January or February. We get a whole slew of one-year extenders. And so there were several. So the CAA included all of these tax extenders. There was over 50 of them. I just pulled out some of the ones that I thought were advantageous. So they made permanent the 7.5% medical expense threshold for individuals that are claiming medical expenses on their itemized deductions. So that has been waffling back and forth between 10 and 7.5%. So they made it permanent at 7.5%. They also made Code Section 179D permanent. So that's the deduction for energy efficient commercial buildings. It really relates to designers of buildings. If you're a designer, you're able to claim that credit for a government building that's being installed, as long as it meets the energy efficient requirements. And they also are inflation adjusting that amount that's available going forward. They extended for 5 years rather than making these permanent. So 45D is the new markets tax credit, 45S, the employer credit for paid FMLA. The work opportunity tax credit was also extended for 5 years, so we won't have to worry about the renewal of that every year. The 127C exclusion for employer payments for student loans was also extended for a 5-year time horizon. So that means that anybody that's able to pay the student loan debt for their employees, they're able to claim that deduction and not have the employees pick it up as income. There were several provisions that were extended for just 2 years. I pulled out a few of them that I've seen here recently. 25D is the residential energy efficient property credit. So if you install solar panels or energy efficient windows or doors, you're able to claim a credit for that. 45Q is the carbon dioxide sequestration credit. And then 48 is the energy investment tax credit for solar and residential energy efficient improvements. So those have all been extended for 2 years. And then 1 year, I don't know what the criteria was for why some of them were 1 or 2, but so 45L is the energy efficient homes credit. So if you're a home builder and you are building houses that meet the energy efficient standards, you can get up to a $2,000 credit for every home that you build. Section 35, the health coverage tax credit, was extended for a year. 30B, which is the credit for qualified fuel cell motor vehicles, was extended for a year. And then 168, which is the 3-year recovery for racehorses that are 2 years old or less, was extended for 1 year. So if you've got a racehorse, you can depreciate it over 3 years. And as I said, there's many more of these extenders that were put into place. If you're curious about a specific one, get with me after or send me an email, and we will be happy to look through there and make sure if it applies to you. So, additionally, during 2020, we had a lot of clarification from the IRS on the Tax Cuts and Jobs Act. I pulled out a few of those items. So this is given us a lot of heartburn over the last couple of years. I know a lot of you are well aware of some of the delays that we've had in filing returns, trying to make sure that we do things according to IRS rules and regulations. We're still getting guidance from IRS on Tax Cuts and Jobs Act of 2017. So we're talking about a bill that's nearly over 3 years old at this point. Still getting guidance there. So the IRS amended the final regulations with guidance on the code section 199A deduction for suspended losses and shareholders of regulated investment companies. The effect is the amendments address the treatment of suspended losses that are included in QBI. So if you have a pass-through entity that is your primary business source of income, you're able to take a 20% deduction against that ordinary income. However, if there were losses that occurred during the year, you have to carry those losses forward. This clarified how the rules are regarding the netting of those losses and the income. So that was good to get that out of the way. The IRS also had issued guidance regarding the 100% bonus depreciation deduction. So previously they had issued many regulations around the qualified improvement property and whether or not you could take bonus depreciation and what years it was available for. So we got much guidance out of IRS for that, for taking bonus depreciation, which is very helpful going forward. The IRS issued final regulations covering the deduction for foreign-derived intangible income and global intangible low-taxed income. So FDII and GILTI, this is the new foreign tax regime that we're under. We have several individuals in our office that are very up-to-date on this and tracking it. Basically, the final regulations maintain the basic approach and structure to the proposed regulations. So they've essentially said, what we told you we thought you should do is what you actually should do now. So, which is nice to not have to go back and change things. They also issued guidance around the GILTI and Subpart F provisions of foreign. So this is only applicable to a few of you with regard to if you have foreign income and whether or not it's high taxed income or low taxed income. And it also this is the GILTI high tax exclusion is what this is referred to, and it basically alleviates the tax burden on that foreign income if it's highly taxed outside of this jurisdiction. The IRS released final regulations that address the interaction of the $10,000 cap on state and local tax and charitable contributions. So they provided some safe harbors for those individuals that are trying to get a higher deduction than $10,000. So there's a safe harbor for business entities to deduct payments that are made to charitable organizations in exchange for SALT benefits. In the beginning, when the $10,000 limitation came out, there were all of these programs that popped up on the market where you could make a charitable contribution in excess of the $10,000 and claim it as a charitable contribution and not state taxes. So they went through and clarified some of those rules, put safe harbors in place. So if that's something that you're interested in, talk to us. We'll go through the program with you and show you exactly what you need to do. Just going to see if we have any questions at this point before I get too much into the state stuff. Or I could just tell a joke. No, just kidding. There are no jokes in tax. So we have a question for businesses that have PPP loans forgiven. Have they established whether the loan amount will be taxed? So yes, they have established that it will not be taxed. So the income is not taxed and the expenses are deductible. So that is very positive. Let's see, we have a question here. So per quarter, so if each quarter drop is more than 20%, the credit is how much for the year? The credit is 70% up to $10,000 of wages. So $7,000 would be the maximum credit that you'd be able to apply for the year. Is the residential solar energy credit limited to principal residences, i.e. vacation homes not eligible? That is correct. It is limited to your primary residence, not to a vacation home. And no jokes. That's all we have. Okay, so I'm going to talk just a little bit about Idaho here real quick and some other states. So just something that I thought would be important to go over. So the governor's State of the State address was was a couple weeks ago on January 11th. He detailed his Building Idaho's Future plan, which includes much with regard to tax relief. Now, just because the governor is proposing this doesn't mean that it's going to be put in place, but we have a pretty good idea of what the governor is going to go for as far as tax relief in the state. So the Building Idaho's Futures plan, the proposals included a couple of different provisions. They have included in there are permanent tax cuts and one-time tax cuts. So the overall proposal was for a $450 million tax cut, and $295 million of that would be in the current year, and $160 would be on a permanent basis going forward. We don't have a lot of details about how much is in each one of these sections, but I just wanted to go through each one to kind of show you what they were thinking about. So included was a doubling of the grocery tax credit and an increase to the circuit breaker for 1 year. So that would be a 1-year provision that we'd be able to get some tax relief. Ongoing tax relief will be accomplished through a proposed income tax reduction. We don't know how much the governor is going for. We don't know how much the legislature will approve, but we do know that there will be a push in the state to reduce tax rates this year. And lastly, the remaining funds will be used to for the cost of conformity. And so conformity is a huge issue in the state of Idaho. So there's two types of states. You have states that have rolling conformity, and you have states that have hardline conformity. And so we're a hardline conform date. Like we don't put in place conformity on a rolling basis. We approve it every single year. And so what that says is when the IRS comes out with rules and when Congress, the federal government, comes out with different laws regarding taxes, the state sometimes conforms to those laws and sometimes doesn't. And so what the governor is saying is he's going to use some of these excess funds to encourage the legislature to conform to the federal code, which in some instances provides a tax benefit over and above what the Idaho code has. So we'll be happy to see that. It makes our lives a lot easier to not have to do your tax return two ways, one for feds and one for state. Also included in the plan was, whoops, sorry, I lost my place here. Idaho's provided, so the last piece of this is that Idaho also, back in July, I believe they passed it, maybe in June, they passed a first-time homebuyer deduction. And so I thought this would be important to point out. It's for individuals that have never owned a home and intend on purchasing a residence in the state of Idaho. It has to be their primary residence. Eligible individuals can contribute up to $15,000 for single or $30,000 married filing joint to an account. So, and these accounts can be established at a bank locally here for the purpose of saving for a first-time home purchase, and they'll be able to get a deduction on their state return. The maximum lifetime contribution that you can contribute to these accounts is $100,000. So you could essentially do it for 3 to 4 years, and then you'd be able to purchase a house as long as the funds are pulled out. That it's not, you would not be taxed on that money in Idaho, and you would have got a deduction for it when you contributed it to it. So it's a good little benefit, I think, that should be available to some individuals that haven't bought a house before. Let's just talk a little bit about Wayfair. So Wayfair has been out for several years. This is the court decision that allowed the states to go after more income. So we continue to see budget shortfalls in many of the states that we have clients that do business in. And those budget shortfalls have led the states to try to find ways to increase their revenue. And they're doing that through the expansion of the Nexus rules that happened with Wayfair. Most notably, they're trying to find any incidental activity that would lead them to believe that you should be taxed in that state. Obviously, California is probably the most active there. I think if you even drive by the border, you are to file a tax return in that state. Fortunately, many of those cases are being pushed through the court system. The states are losing, especially in the Ninth Circuit, on this issue. So there has to be an economic substance in the state in order for you to be taxed there. You can't simply just be shipping something there or have some incidental relation to the state in order to have to file there. So if you're operating in multiple states, you want to check those out. You want to make sure that you're complying with all the rules. And the biggest thing is we don't want to fall into a situation where you were unaware that you have to file a return in a state. So if you have any activity in those states, bring that up to your accountant, whoever it is. Make sure that they're aware of it so we can do a full kind of review to make sure that we're complying with all the rules and regulations. So the last piece of this is guesses about 2021, what's going to happen. So as many of you probably saw here in the last hour, we have a new president, Joe Biden. He has published some vague ideas about what he wants to do with tax planning. And I'll talk a little bit about the realistic possibility of those things happening. So right off the bat, bullet number 1 on his tax plan is to increase the highest personal income tax rate back to 39.6% from 37%. That was reduced with the Tax Cuts and Jobs Act. He additionally wants to limit itemized deductions on high-income earners. This is called the PEAS limitation. It was wiped out with Tax Cuts and Jobs Act. So he's essentially reversing that. He wants to limit like-kind exchanges. So not only was like-kind exchanges limited by Tax Cuts and Jobs Act to only real property, now he wants to limit it to only individuals that have income less than $400,000. So if your total income is over that, you would not be able to like-kind exchange anything, including real property. He'd like to phase out the QBI deduction. So by phasing out QBI deduction, that would be a massive hit to small business. 95% of the small businesses in the country are S corporations that pass out their income and are eligible for the QBI deduction, which is 20% of that income, as long as they're not a service business like myself or attorneys or doctors. And so those are just a few of the things that have been on the front boilerplate as far as his proposals. He also would like to have tax increases for anyone. He promised that he wouldn't increase taxes for anybody that makes less than $400,000. However, there are a couple of provisions that, if you think about it, these probably would apply to individuals that make less than $400,000. So he is pushing hard to eliminate the step-up in basis for inherited assets. So any individual that inherits an asset from their parents or when they pass away, those assets are subject to estate taxes, and that estate tax limitation is $11.5 million approximately. And that therefore gives you the ability to step up that basis of that asset to whatever the fair market value is when that person passed away. So he has proposed to eliminate the step up. So that would essentially create more tax on any individual that had received that asset. So it's passing the tax on. Secondarily, he wants to increase capital gains taxes for those earning over $1 million. So he wants to do away with the preferential capital gains rate for those high-income individuals. There are a few tax cuts that are in there. So he wants to increase the child tax credit to $3,000 for any child that's over the age of 6, and to $3,600 for children that are under the age of 6. Expand the child independent care credit to $8,000. Forgiveness of student loan debt is kind of a big innocuous thing. We don't know exactly what that means, but I think we can all imagine what that would do. Expand the work opportunity credit, and then focus on expanding access to retirement funding. So there's a lot of specific proposals about making retirement funding equal and more available to individuals, and incentivizing employers to offer those plans. So with all of that, like, what are the realistic possibilities of significant tax changes in 2021? Well, as many of you know, I always talk about the fact that tax legislation originates in the House of Representatives and is under the direction of Congressman Richard Neal. He is the chairman of the House Ways and Means Committee, and that's where tax laws get written. So it has to first come from there. With the razor-thin margin in the Senate, abolishing the legislative filibuster is nearly impossible. So with a 51-50 majority in the Senate, already Joe Manchin has said he would not support eliminating the filibuster. And what that does is it ensures that tax legislation has a limit. Basically, everything expires within 10 years unless it's paid for. So it makes the tax writing much more difficult. And so I think we won't see any significant legislation coming out of 2021, but there will probably be some things come up in the very end of the year. So some things to think about. I just want to go through these rather quickly. I know we're kind of short on time here, but so consider the 2020 tax filing season. So the IRS has already come out and said we'll not be able to accept returns until February 12th. That's typically about January 15th. So that is unfortunate. It's going to delay tax season for us. We're not even able to start. It's because they're processing the economic recovery payments. They're just getting forms out, so please be patient. We will have to wait for them to be available to accept our returns. Consider, as I said before, employee retention credits. If you think that you're eligible for an employee retention credit, please do the evaluation. It is a very beneficial credit and could offer a significant amount of cash flow to your business. We can help with that. If you need help, just reach out to any of us here at Harris CPAs, and we can assist you in that process. Consider second round PPP loans. I know I've talked to several clients just in the last few days about a second round of PPP program loans. I know the guys over at Washington Trust do a great job on their PPP loan program, and I've talked to several of them. I know that they're knee deep in second applications for Paycheck Protection Program payments. So if that's something that you're eligible for, reach out. That cash is there to incentivize the economy, so we want to get that in the right hands. Consider filing amended returns. So if you placed significant assets in service in 2017, 18, or 19, and those assets are being depreciated over a long period of time, we're going through and looking at many of our clients' situations to figure out whether or not we should accelerate depreciation, create losses, and carry those losses back to get you immediate refunds, immediate cash flow in your business. That's a great way to do it. We have to temper that with the possibility that tax rates go up in the future, so it is kind of a complicated situation that we got to go through. With the ability to write assets off in full right now, cost segregation studies are very valuable. The ability to segregate assets throughout a building that you've constructed or purchased and deduct them in full can give you a huge tax benefit. So consider putting in place a cost segregation study if that's your situation. Don't forget that the Tax Cuts and Jobs Act sunsets, so most all of the provisions go away in 2026 anyhow. So if we lose something a little bit early, it's probably not as dramatic a situation as we would want to think, but it is, many of those provisions are going to sunset, so just be aware of that. Capital gains taxes. So if you're in a situation where you think capital gains tax is going to be attacked by the administration and you have significant capital gains taxes that you could pay, consider accelerating them, whether it's through an installment sale or whether it's through a sale in the current year. It's something that you want to consider in stepping up your basis while tax rates are low. Like was mentioned before, I think many of the capital gains rate changes would be retrospective and not back in time. So consider gifting. So with inheritance taxes, with the limitation being restricted, and if there is a loss to the step up in basis, consider gifting. It's a great way to get assets out of your estate and into your next generation without, and if we can get that accomplished before there's any tax changes, definitely want to look at that. And then lastly, review your tax rates. Make sure that as your rates change, that your corporate structure is the most advantageous. If the individual rate goes to 39.6 and we lose the QBI deduction, it's going to shift the benefits of having a C corporation greatly, because if they don't change the C corporation rates, then we're still getting 21% on that side. So we want to make sure that we look at structure to get you the best result possible. So with that, I'm gonna take a few more questions. Does the 25% reduction in revenue for the second round of PPP have to show for the entire year? I do not believe so. I think it only has to show for a quarter. Does the education credit apply to elementary, secondary tuition for kids under 18 as well as college tuition? The lifetime learning credit was expanded, I believe, but I'm not sure. I will get with you and give you that answer. Is there any expectation for the tax deadline to be pushed back? Yes, I do think, this is my personal opinion, we have not heard anything about the tax deadline, but with the season not opening till February 12th, it gives us a very compressed time frame to get a lot of returns done. I do think that towards the beginning of March, middle of February, we will get guidance from the IRS that will push the due dates out for corporations and for individuals. So, oh, they're coming in hot and heavy. For the employee retention credit, is the comparison between 19 quarters to 20 quarters. Actually, you get to choose between 19 or 20. So you can compare 2021 to 19 or 20, whatever gives you the most benefit. So you want to look at that to make sure whether or not you can qualify for that. It has been reported recently that there will be a 50% uptick in small business audits by the IRS in 2021. What are your thoughts on this? IRS audits. Almost impossible to get an audit done right now. The IRS is still working from home, and many of you that have had issues with the IRS understand they've been posting payments in the wrong place, they've been posting payments to the wrong years. For us to get a hold of them, they are working from home, and so it is very, very difficult to get issues resolved. I do not think with the stress of the change in the administration, we'll see what happens when the new commissioner is installed. There will be a new IRS commissioner that will be installed eventually. I don't think Biden has named him yet. His focus will be in a certain area, and at that time we'll know. But just with the economic situation the way it is right now, I don't think that there'll be an uptick in audits. They can't handle, we're still dealing with the audits from 3 years ago, so they can't even handle that. Will the student loan debt cancellation be taxable if passed? I would imagine that it will not be taxable since you got a deduction for the student loan interest, but we'll just have to wait and see what the final proposal includes. So with that, sorry to have to go so fast, but I had a lot of slides to get out, so I talked as fast as I could, and we appreciate each and every one of your attendance. We appreciate all of your continued support throughout the year, and we have been blessed by many of you and are extremely excited about the coming year. please reach out to us so we can get together. We would like to talk to you as much as possible and get the information that you need. And with that, I hope that each and every one of you has a great rest of your week, and we'll talk to you soon. Thanks.